measurement. Another chapter on conceptual framework. So we measure financial statements figures, especially relating to assets, on four different bases: historical cost basis, current cost basis, fair value basis, and value in use basis. Historical cost, current cost, fair value, and value in use. Historical cost means the normal companies apply this method like we record asset cost less accumulated depreciation. That is called historical cost basis. Mean at what amount we bought the asset or we constructed the asset less accumulated depreciation. We record asset on carrying value regarding this formula. What is the worth of this asset in the market now? No, we are just recording on cost basis. Current cost basis means according to current value of similar asset in the market. According to current value of similar asset in the market. That is current cost basis. What is the fair value basis? According to market value, less cost to sell. You can say at net realizable value. In fair value, less cost to sell. And what is value in use? Based on present value of future benefit of the asset. Based on present value of future benefit of the asset. So there are a number of measurement bases mentioned in the IFRS conceptual framework for financial reporting. Most items are held at historical cost, but the mostly and widely used is historical cost basis method. Current cost is normally only used as an alternative to historical cost accounting, taking into account inflation. Taking into account inflation. This will be investigated further in this chapter. Some items such as revalued asset or investment may be revalued to fair value being the realizable value. Present value may be used in respect of item with cash flows that is based on value in use. Now we need to study some detail on these methods, their advantages, their disadvantages, etc. So let's discuss historical cost basis first. This is a traditional method that is most widely used. Accountants have been presented using the historical convention. Assets are stated in the statement of financial position at their cost, less any amounts written off, for example, depreciation of tangible current assets mean based on carrying value basis. The objective of financial statement is to provide information about the reporting entity's financial performance and position that is useful to certain type of user of assessing the stewardship of directors. What does it mean by stewardship? Stewardship is a concept which means managing property of others. Property mean assets of others. Directors are steward to shareholder. Mean they are managing shareholder property mean company. So by stating asset on historical cost basis, directors showing steward towards shareholder. Like what is the value of your assets? While being both easy to ascertain and objective, the historical cost basis of measurement fails to relate directly to any of three decisions that might reasonably be made without an asset. Mean in these three situations, historical cost method will fail. Another similar asset might be purchased. ultimately the other asset value in the market will be different. The asset value in your book will be different. So, madam, we need to know the current replacement cost, which might have changed substantially since the present assets was purchased at its historical cost. This means in this situation, they need to record on current cost basis. The asset might be sold. We cannot sell at the carrying value. And for this, we need to use fair value method. Fair value less cost to sell, net realizable value. Madam, we need to know the amount which would be realized from sale, less any cost involved in disposal, i.e. net realizable value. And the asset might be used in the business. If we are using, what benefit it will provide in future. And for that, we need to use value in use method. Meanwhile, these methods have been introduced. The other three methods, why they have been introduced. To know replacement cost, we should use current cost method. To know what we can realize by selling the asset, fair value less cost to sell method will be used. And if we are using the asset, what benefit it will provide in future. So for that, we need value in use method. So we need to estimate the future cash flows arising from the asset and discount these to their present value, i.e. their economic value. Clearly, there is no direct link with historical cost in this case. The traditional approach to accounting has the following features. Accounting transactions are recorded at their original historical monetary cost. Items or events for which no monetary transaction has occurred are usually ignored altogether. Income for each period is normally taken into account only when revenue is realized in the form of cash or in some form which will sooner be converted into cash. In future income, we do not record according to historical cost basis. We record income when it is realized. Profit for the period is found by matching income against the cost of items consumed in generating the revenue for the period. Such items include non-current assets which depreciate through use, obsolescence, or the passage of time. Mean we calculate profit by deducting expenses from the income, including depreciation expenses. These features of accounting have served user well over many years. Traditional. That is widely used. What are the advantages? Easy to understand. Straightforward to produce cost, less limited depreciation, don't need to look for market value, active market value, specialist expert value, calculating discount factor, value in use. Historical cost accounts are objective and free from bias because there is no estimates involved. Like value in use involve estimate of future concepts, estimate about the discount factor. Historical cost values are reliable and original values can be confirmed based on original invoices and documents. What is the cost? You can verify from the invoice. What is fair value? How we can verify? From where you will get the market values? Stock exchange or market listed prices of different companies. That could also vary. The same spec mobile sell by Samsung is having different value. The same spec mobile sell by Oppo is having different value. Historical cost financial statements do not record gains until they are realized. Mean we record income when they are realized. Future income will not be recorded. But there are some disadvantages. Carrying amount of non-current asset is often substantially below current value. I mean, the similar asset in the market is of high value. Inventory in the statement of financial position reflect the prices at the date of purchase or manufacture rather than those at current year value. Inflation is not incorporated. Statement of profit or loss expense do not reflect the current value of asset consumed. We are charging depreciation, but might be we have consumed the asset more. So depreciation could be understated. Through this, we can say profit could be overstated. If profits were distributed in full, the level of operation would have to be curtailed. And if we don't keep reserve, we cannot adjust revaluation losses of asset. No account is taken of the effect of increasing prices of the monetary items designated are settled in cash. Mean we are not incorporating the effect of inflation. The overstatement of profit and understatement of asset prevent a meaningful calculation of return on capital employed. What is the formula to calculate capital employed? Capital employed is equal to profit before interest and tax divided by capital employed, mean equity plus long term, or we can say total assets minus current liabilities. If you are not charging depreciation as per actual consumption of the asset, ultimately profit will be overstated and assets will be understated. If you are not recording asset value as per current market value in the market, including inflation, asset could be understated. And if your profit are overstated using historical cost basis, assets are understated using historical cost basis, ultimately we cannot calculate meaningful capital employed because this profit is overstated, this capital employed is understated. At this point, we need to learn in historical cost basis, the profits are overstated and assets are understated. This is important one. As a result of the above, user of financial statements find it extremely difficult to assess company's progress from year to year or to compare the result of different operations. Because now the market is different, value different, price is different. But you have recorded 5 years back values. The user cannot compare current with past. And they are explaining through example. Company A acquires a new machine in 20x4. This machine cost 50,000 and has an estimated useful life of 10 years. This means 50,000 is the cost, no residual value. Life is 10 years. This means 5,000 is the annual depreciation. Company B acquires an identical 1-year-old machine in 20x5. The cost of machine is 48,000 and it has an estimated useful life of 9 years. Mean for this, 48,000 divided by 9, what is the depreciation per year? 5,333. So depreciation charge, straight line basis, nil residual value in 20x5. What is the value of company A asset machine at year end 20x5? So cost was 50,000. 20x4 depreciation is 5,000. 20x5 depreciation is 5,000, and carrying value we are having 40,000 for A. What's the carrying value for B? We bought on 48,000 and we charged 20x5 depreciation of what? 5,333. Carrying value is 42667. The machine are of same nature, but at 20x5, their carrying values are different. Both companies are using identical machines during 20x5, but the statement of profit or loss will show quite different profit figures because of adherence to historical cost. Because one machine, obviously cost is lower. That's why its depreciation is lower. Other machine cost is higher. That's why its depreciation is higher. Even based on useful life, we are having different depreciation. So this is the issue with historical cost basis. We cannot compare one company data with other company. Other assets value. I mean, what are the other methods? Replacement cost. Replacement.
So wouldn't that be correct first?
I mean, they have just explained by having historical cost basis, the same nature asset are having different values. This asset is used by 2 years and it having value 40,000. This asset is used for 1 year and it having value almost near to that. Other asset values, replacement cost is the cost to the entity of replacing the asset. Mean if company want to buy new asset by selling this old asset. If this asset carrying value is say 40,000, so you cannot replace this asset in 40,000 because now the prices in the market are different. The supplier will charge you according to current prices. However, if a non-current asset situation, you will need to determine the asset's net replacement cost. Net replacement cost is the replacement cost of an asset less an appropriate amount of depreciation. For example, an asset with a historical cost of 500,000 and a life of 5 years would have a carrying amount at the end of year 2 is 300,000. Why? Life is 5 years, 100,000 is the depreciation. After 2 years, its carrying value will be 300,000. If the current purchase price of an equivalent new asset at the end of year 2 was 600,000, then the value using replacement cost would be 360. Because if we use that another asset according to current price for 2 years, ultimately the depreciation will be more 120 and the carrying value will be 360. So we cannot replace the old asset with the new asset with the similar amount. Net realizable value, also known as a fair value less cost to sell, is an estimated sales proceed less cost involved in the selling asset. Economic value mean value in use is the present value of future cash flows from an asset. Mean what are the other bases to value measure asset. Illustration 2. We need to calculate historical cost, net realizable value, replacement cost, and economic value. A company owns a machine which it purchased 4 years ago for 100,000. Cost is 100,000 4 years ago. The cumulative depreciation on the machine to date is 40,000. What is the carrying value? Cost 100,000. Accumulated depreciation is 40,000. What is the carrying value? That is 60,000. How many years this depreciation we have charged? For 4 years. What is per year depreciation?
And
10,000 per annum. 10,000 we can say is 10% of cost. This means 10 year is the life of the asset they have determined based on historical cost basis. Is that? So we have calculated historical cost that is 60,000 value. The machine could be sold to another manufacturer for 50,000, but there would be dismantling cost of 5,000. So using net realizable value, what is the cost? 45, 50 minus 5. To replace the machine with a new version would cost 110,000. And we have covered this example. And if we apply this depreciation rate on the new machine, that is cost 110,000. What is the depreciation per year? 10%. What is 10%? 11,000 depreciation at the rate of 10%. We are having carrying value of how much?
after 4 years, right?
After 4 years, yes. So we can say multiply by 4. So 110,000 multiplied by 4 will be 44,000. So carrying value will be 66. Yes. So this is replacement cost of the similar asset. The cash flow from the existing machine are estimated to be 25,000 for next 2 years, followed by 20,000 per year for the remaining 4 years of the machine's life, and discount factor is 10%. For year 1, year 2, the cash flow will be 25,000, 25,000, and from year 3, 4, 5, 6, mean year 3 to year 6 are of 20,000, and discount factor at the rate of 10%. That is 0.909, that is 0.826. And for this, they have provided us annuity factor that is 2.619. Can you calculate PV?
95,755.
Altogether, 95.
755.
So this is 95755 is the value in use or economical. Examiner could ask these kind of things in MCQs. So 60,000, 45,000, 66,000, and 95755. Alternate to historical cost accounting. Mean we have learned 4 methods: historical cost, current cost, net realizable or fair value cost, and value in use. There are 2 more methods: constant purchasing power and current cost accounting. What is constant purchasing power? Constant purchasing power. Inflation. Constant purchasing power mean inflation. If we are having $100 now, what will be the value of this $100 in future? Same? Remain same? No. The value will reduced over the years. Why? Inflation. Due to inflation. In year one, might be its value will become 98. In year two, might be its value will become 95. In year three, its value will become might be 91. In year four, might be its value will become 88. In year five, might be its value will become 82. In year six, might be its value will become 79. Like if through this $100, we can buy 50 chocolates now, today. After year one, might be we can buy only 45 chocolates to $100. After 2 years, might be we will be able to buy 42 chocolates with $100. Why? Due to increase in price. In this $100 is a value of 50 chocolates. After year one, its value will be equal to 45 chocolates. After year two, its value will be equal to 42 chocolates. That's why this value of 100 will be reducing over the year. That is called constant purchasing power, mean price index. Constant purchasing power mean price index. In the similar manner, suppose we have recorded an asset with 1 million amount. We bought 1 million at cost. Next 5 years, we are saying this is cost, this is cost, this is cost. But that cost value is not the same in coming year because we are not taking into inflation effect. Its value will reduce, reduce, reduce. If we are not incorporating that reduction in value, this means our assets are overstated. So, as historical cost accounting has been criticized for providing information that is out of date and potentially understate asset values. Current value accounting has risen as an alternative. This largely takes two forms: constant purchasing power and current cost accounting. What is constant purchasing power? Financial statements are adjusted to show all figures in terms of money with the same purchasing power. A general price index, mean inflation, is used for this, applying a general level of inflation. Figure in the statement of profit or loss and statement of financial position are adjusted by the constant purchasing power, mean inflation. And if we are recording figures in the financial statements adjusted by inflation, that is alternate accounting called constant purchasing power costing. CPP factor, index at the reporting date, index at the date of initial recognition. In converting the figures in the basic historical cost financial statements into those in the CPP statement, our distinction is drawn between monetary item and a non-monetary item. There are some monetary item in the financial statement, some non-monetary item. What are monetary items like cash, receivables, payables, loan? If we have obtained loan from the bank, whatever the amount of the loan, we need to pay back that amount in future. Whether that amount is having value of that or lesser or over, we need to pay the loan amount same. If we are having receivable, we will receive the same amount from the customer in future. So on monetary value, we do not apply the inflation effect. No inflation effect on monetary value like receivable, cash, payable, and loan mean long-term liabilities. Because customer will pay the same amount, we will pay the same amount to the bank. While for non-monetary items such as inventory, non-current assets that physically exist based on quantity, we need to apply inflation effect. When using CPP costing, we need to apply inflation effect on non-monetary items like inventory, non-current assets, but we do not apply inflation effect on monetary items, monetary values like receivables, payables, and loan. Just this point we need to remember. What is a CPP? Preparing financial statements based on inflation effect, current price index effect. Can you understand this? There are some advantages of this CPP accounts method. CPP accounting is both simple and objective. It relies on a standard index. It adjusts for changes in the unit of measurement and therefore is the true system of inflation accounting. It measures the impact on the entity's terms of shareholders' purchasing power. Mean according to purchasing power, we are adjusting everything. But there are some disadvantages. It failed to capture economic substance when specific and general price movement diverge. Economic substance, economic reality. I mean, it not considering the economic reality.
So the inflation happens in different industries.
Exactly. Exactly. The unfamiliarity of information stated in terms of current purchasing power mean inflation information. If you are not getting correctly, ultimately figure will be different. CPP does not show the current values to the business of assets and liabilities. The general price index used is not necessarily appropriate for all assets in the business. Why? Because in market, the new asset might be is having a different feature. Its efficiency is better than your old asset. But you are adjusting as per inflation your old asset, as per current prices in the market. What is the current cost accounting? It is based on deprival values are value to the business. Deprival value is equal to the loss suffered if deprived of the asset and is usually represented by the replacement cost. Mean in how much amount we can replace the asset with old. The similar like we have calculated in this example.
That's current cost.
This is the replacement cost model.
So what's the difference?
The same replacement cost is this method, what is named current cost method.
Two names of the same thing.
Yeah, current cost, replacement cost is the same meaning. Inventory and non-current assets are valued at deprival value in current market value. Monetary asset, cash, receivable, payables, loans are not adjusted. An additional charge to the statement of profit or loss reflect the deprival current value of inventory within cost of sales. Because now we are recording everything according to current market value. An additional charge in the statement of profit or loss reflects the deprival value of non-current assets depreciation as well. In as per current value, the depreciation will be different that we have calculated in previous question. Current cost or replacement cost accounting is not a single system of accounting. There are several variants who will concentrate on general principle. In particular, these relate to inventory and non-current assets. The current cost statement of profit or loss is charged with the value to the business of assets consumed during the period. In particular, the charge for consuming inventory, cost of sale, and non-current asset depreciation are based on current rather than historical value. Mean it is resolving the issue of overstatement of profit that is relating to historical cost basis. The current cost statement of financial position reflect the current value of inventory and non-current assets, mean asset will not be understated. Advantage, the most important advantage of current cost accounting is relevance to user. In according to current value, they can see the financial statements. User will be able to assess the current state or recent performance of the business, and assets are stated at their value to the business. But there are disadvantages, possibility, greater subjectivity, and lower reliability than historical cost, because the values you need to find from the market. Lack of familiarity might be the current model in the market is not familiar with the model used by the business they bought several years ago, like especially in motor vehicle industry. The old car was more stronger than the new model of cars. There could be complexity in calculation. Current cost accounting only adjusts value for non-monetary asset, not all asset and liabilities. In monetary asset will remain same. Not covering the whole financial statement even. Receivables, payables, loans, they will remain same.
So if you're using current cost or the replacement cost and the market value of the asset decreases, so do you record it at lower value?
So basically lower value according to current cost.
And if it increases, you increase the value.
Yeah. I think that's it. Let's move towards questions now. MCQ 1. Which of the following measurement bases are referred to in the board's conceptual framework? Current cost, residual value, fair value, present value. Historical cost is not there, so A is not the option. B, current cost, historical cost, fair value, present value. C, current cost, fair value, present value, future value. No, future value is not there. Future value is not there. So which option? Number 2, which of the following statement is true about historical cost accounts in terms of rising prices? Profits will be overstated and asset will be understated. Yes, this is the main point. Assets value will be overstated. No. Unrecognized gain will be recorded incorrectly. No, they will be recorded correctly when they realize. Depreciation will be overstated. No, depreciation is overstated in replacement cost rather than historical cost. Number 3, which of the following is an advantage of a current cost accounting over historical cost accounting? Easy to understand, less subjective, more relevant, more reliable. More reliable. Easy to understand is historical. There is subjectivity involved. What is the current value? More relevant? Now, more relevant is historical cost. This chapter finish. Yes, let's move towards MCQs. Again, number 9, the process for developing an IFRS accounting standard involves a number of stages. Following receipt and review of comments on a discussion paper, what will be the next step undertaken by the International Accounting Standard Board? In after discussion paper, what is the next step? Ultimately, exposure draft. Which two of the following statement would be an advantage of adopting IFRS accounting standard? What are the advantages of adopting IFRS? It would be easier for investor to compare the financial statements of companies with those of foreign competitors because companies are following international accounting standard. Cross-border listing would be facilitated. Mean foreign investor can understand and buy shares properly. Accountants and auditors would have more defense in case of litigation. No, 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 no. The IFRS accounting standards can be more easily tailored to reflect the industries of the tertiary adopting them. Tertiary adopting them, the IFRS accounting standard can be more easily tailored to reflect the industries of the tertiary adopting them. No, according to tertiary, there will be different rules. So one A and B, 11. Which two of the following statements regarding system of regulations of accounting are true? Principle-based system will require more detailed regulation than a rule-based system. Now, while defining strict rules, you need to cover each and everything. In principle-based, is everything, anything is not covered that they can deal by providing justification. So this is wrong. A rule-based system will tend to give rise to a larger number of IFRS accounting standard than a principle-based system. Yes, you need to cover everything. A principle-based system seek to cover every eventuality. No. A principle-based system requires the exercise of more judgment in application than a rule-based system. Yes, judgment will be applied by providing justification. Number 12. The purpose of developing an IFRS accounting standard involves a number of stages during the early stage of a project. The International Accounting Standard Board will undertake consultation on the key issues. Which of the following is correct regarding the early stage of the process? In the early stage of the project, the board will issue a discussion paper to obtain views from the public. You take views on discussion paper or exposure draft? Exposure draft, this is wrong. Because discussion paper is circulated among board bodies. In the early stage of the project, the board will consult with the advisory committee and IFRS advisory council to seek out the key issues. Yes, they need to discuss with each other. In the early stage of the project, the board will issue a discussion paper, then consult with the advisory committee. And they will issue discussion paper, then consult with advisory committee. No, after discussion paper, they need to issue exposure draft. Advisory committee will be concerned before discussion paper. In the early stage of project, the board will issue an exposure draft to obtain views from the public. No, early stage. This is not the early stage. I think B is correct option. 13. Historical cost accounting remain in use because of its practical advantages. Which of the following is not an advantage of historical cost accounting? Mean disadvantage. Amounts of transactions are reliable and can be verified using historical cost basis. Reliable and can be verified through documents, invoices. So this is advantage. Amounts in the statement of financial position can be matched to amounts in the statement of cash flows. Yeah, that is based on whatever cash paid. That is advantage. It avoids the overstatement of profit, which can arise during a period of inflation. No, it doesn't avoid overstatement of profit. So this is not the advantage. It provides a fewer opportunity for creative accounting than a system of current value accounting. Yes, because it is based on history. Number 14. Which of the following statement about the International Sustainability Standard Board ISSB is correct?
Was that?
We haven't studied this. Actually, this book has been revised. This topic was before in the book. Now that topic is eliminated from the book because we are using current book of 2024. This kit MCQs might be some having some old MCQs. Let's see what is Sustainability Standard Board. Sustainability. What is meant by sustainability? Company should focus on environment, protecting environment. Company should bear some environmental cost. Company should meet some expenditure to save the environment. The ISSB will issue mandatory laws that companies complying with IFRS will be required to apply. No, for sustainability, you cannot issue mandatory laws. There should be some flexibility. B, the ISSB, mean International Sustainability Standard Board, will initially focus on climate related disclosure. We require company to provide disclosure regarding your business activities impact on the environment. Obviously, company will try to put a positive disclosure, and to put a positive disclosure, they will automatically focus on environmental issues. So this is main point. But you see, the standard issued by the ISSB will replace those issued by International Accounting Standard. No, no, no. Accounting standard are more important. Sustainability is secondary. There has been no provision guidance for preparation of financial information in respect of sustainability disclosure. No, there is guidance. Company need to comply some environmental laws, environmental policies, and they need to disclose in the annual report. Number 15. Good luck, everybody. You need to calculate the historical cost amount and current cost amount. We have already covered this. We have covered two examples on this. Similar, only the values are different. Even the answers are given. Come on, give me the values.
320.
320 for here.
Yeah.
And what about
384.
384 here? In this and this. How? On 1st October 20x2, the cost is 500,000. It has a useful life of 5 years, straight line depreciation, and an estimated residual value of 10%. What is 10% residual value? 50,000. So 450 depreciable amount divided by 5 years, that is 90,000 per year depreciation. 90,000 per year depreciation. Okay, historical cost or current cost as appropriate at 31st September 20x4. So from October X2 to September 20x3, 2 years depreciation, that is 180. If we deduct 180 from 500, we will arrive at 320. Okay, at 30th September 20x4, the manufacturer of the plant still make the same item of plant and its current price is 600. Now apply on 600. 600, what is the 10% scrap value? 60,000. So depreciable amount is 540. 540 divided by 5 years. The annual depreciation is what? 108,000. And 2 year depreciation will be 216,000. And if we deduct 216,000 from 600,000 cost, so we will arrive at 384,000. Similar two examples we have covered so far. You know? Okay. Number 16, under the current value measurement basis, what is the definition of fulfillment value? The amount of considering received to incur the liability less transportation cost, the price that would be paid to settle the liability at the measurement date, the consideration that would be received for incurring an equivalent liability at the measurement date, the present value of the estimated cash flows needed to fulfill our liability under the current value measurement basis. What's the definition of fulfillment value? Economic value, value in use. Fulfillment value mean economic value or value in use. What's the definition of that? Present value of estimated cash flow. 17, which of the following statement is an advantage of using the value in use measurement basis? It assists our user to assess the future prospects of the business. Yes, we can see future cash flows. Amounts used are objective and free from bias. No, that is historical cost. It is an easily understood system of valuation. Amounts are reliable and can be verified through invoices. That is also historical cost. So what is A? 18. Under the current cost measurement basis, what is the definition of the value in use measurement method? Cost incurred at the time of acquisition. No, that is historical. Present value, future cash flow less cost of disposal. Yes, residual value will incorporate while calculating. Open market value of an asset. No, that is current cost. Open market value of asset. No. 19. Which statement best describe the intention of the International Sustainability Standard Board? To develop a standard that result in a high quality.
So will these SSP questions come for lunch?
Just we are covering these two MCQs.
Oh.
We got some idea what is that. So describe the intentions of ISSB. to develop a standard that result in a high quality, comprehensive global baseline of sustainability disclosures focused on the need of investor and the financial market. So this is the main purpose. Just read this line 2 times. You can understand what is this ISSB. We are having one more question as we are having good 15 minutes left. So I know it's boring. I know it's boring. Okay. The content of Lisbon is considering a number of transactions and events and how they should be treated in accordance with the concept and qualitative characteristics of financial information as set out in the conceptual framework. During the year ended 31st March 2026, Lisbon experienced the following transaction or events. Number one, Lisbon sold an asset to finance company and immediately leased it back for the remainder of its useful life. They sold the asset, get the money to invest somewhere, and they acquire that asset on rental basis to whom they sold. Might be the new buyer, the new investor is buying asset for generating rental income. That is called sales and leaseback. They got the money of the asset. They are still using the asset. That money they have invested somewhere in a project, might be they are generating more from the project instead of rental. The transaction meet the criteria to be recognized as per IFRS 15 revenue from contract with customer. The accountant determined that the transaction should be treated as a sale and leaseback in accordance with IFRS 16 leases and has accounted for it accordingly. And this should be recorded as per IFRS 16 leases, sale and leaseback. Number two, the company's statement of profit or loss prepared using historical costs showed a loss from operating in its shop. Lisbon is aware that the increase in value of its property during the period far outweigh the operating losses. Lisbon is aware that the increase in value of its properties during the period far outweigh the operating losses. Number three, inventory has historically been valued using the FIFO method, but the accountant is considering the charging to the AVCO method for the year to 31st March 2026. So first is about sales and leaseback. Second is about losses in shops due to historical cost. Third is about changing method of inventory from FIFO to AVCO. MCQ number 20. The accountant is aware that some members of the board of Lisbon have little understanding of accounting and is worried about presenting the financial statement to the board meeting. In accordance with the conceptual framework, how should the accountant deal with this situation? I mean, they are going to present financial statements, but company board of directors have no understanding about financial statements, how this situation should be dealt with. Part A. In doing the presentation, the accountant should omit any complex issues, so that everybody can understand what they are saying. If they are omitting complex issues, that will not be complete. The accountant should open the presentation with the advice that some of them may not understand all of it. The accountant should classify, characterize, and present the information clearly and precisely. By classifying everything separate, they will be able to understand. The accountant should deliver their presentation just to those who are financially qualified. No. Option C. Option C. 21. Which concept of qualitative characteristics has influenced the decision in one above? What was one? Sale and leaseback. I mean, they have recorded as revenue, while auditor says no, it should be recorded as per sale and leaseback. Which concept is not fulfilled? Faithful representation, verifiability, accruals, comparability. Faithful representation, complete neutrality, free from errors. If they are not following IFRS 16, financial statements are not free from errors. Verifiability should be independent reviewed. Accruals, that is different concept. And comparability, previous year figures. 22. In looking at issue 2 above, based on historical cost basis, companies incurring losses, the accountant decide that property should be revalued. Which concept or qualitative characteristics has been applied in making this decision? Has been applied making this decision: materiality, going concern, relevance, or timeliness. Which concept or qualitative characteristics has been applied in making this decision? Number 2, the company's statement of profit or loss prepared using historical costs show a loss from operating its shop. Company is aware that the increase in value of its property during the period far outweigh the operating loss. Mean if we increase the value of our property, that gain will convert the loss into profit. So which concept of qualitative characteristics has been applied in making this decision? Materiality is not there. Going concern, timeliness, that is not there. What was relevance? What was relevance? There are two concepts we studied in relevance.
Materiality, confirmatory value.
Confirmatory value. Means financial statement should be prepared as per accounting records. As per accounting records, there is loss. Exactly. 23, because of the loss arising from operating the shops, the accountant is considering whether company is a going concern. Obviously, there are losses. If it was decided that company was no longer a going concern at 31st March 2026, which of the following is correct in accordance with conceptual framework? If company is not going concern, what you need to do? You need to prepare financial statements based on alternate basis. Financial statements do not need to be prepared. All the assets should be liquidated. Means sell off, no. The financial statement should be prepared on a different basis. The financial statement should be prepared as normal, no. Shouldn't be prepared as normal. They should be prepared on different basis, and that should be disclosed. Because company is not going concern.
Aren't the assets also going to be liquidated?
Liquidate mean sell, dispose of.
It's current assets, disposable.
No, don't need to dispose of. You cannot dispose of. You need to show all non-current asset under current asset.
Okay.
At the time of winding up, you will dispose of. Not before that time. 24. in applying the enhancing qualitative characteristics of comparability, how should the change of inventory valuation basis be accounted for? They are changing inventory valuation from FIFO to AVCO. The change should be disclosed only. The financial statements for 31st March 2026 should show both methods. No. If you are changing, you should account for using that method only. The notes should show what the profit would have been if the charge had not taken place. Now you need to value inventory on new method.
Okay.
The financial statements for the prior period as shown at 31st March 2026 should be restated using a weighted average method because you want to meet comparability. So if in previous year the method was different, current year you are calculating figures on different basis. So you need to restate the previous values on the same accounting policies for comparability so that both should be having same policies because we need to focus on comparability. For comparability purpose, though previous financial statements were prepared on FIFO, but now you are preparing on AVCO, so past year results that are going to affect to this method should also be restated and disclosed where in notes to the accounts. Option D is the best option. Not only disclosure, you need to restate and then provide disclosure. That's it for today. Hope to see you next class.